line, which hopefully they can hear me with the microphone.
Yeah.
And Gwen's gonna let me know if they have any questions.
Mm-hmm. Okay, so asset allocation, that's me. So what are assets? If you break it down, it's stocks, bonds, cash, real estate, cryptocurrency, other things. There are some other alternatives that are out there. But let's look at these assets and how they kind of compare to each other. So, I don't know if you guys can see the screen. I'll just talk it through. So this one is from 1985 to 2020. And this is telling you, here's a bunch of asset classes, and it's telling you what their average earning is over that time period. Like here's an earning year, gold 3.2, high yield US bonds 5.5, but it's also showing you this range of what it could be during that time period. So this is based on actual data. So from 1985 to 2020, if you had US small cap stocks, which means small companies, they have small capitalization, it might have gone up to 43%, but it might have gone down to negative 36. But if you lasted through that time, you would have gotten an average of 9%. So this number here, this is the standard deviation. So the standard deviation is kind of that range of how far apart it could go. So the riskier ones are the ones that have a higher standard deviation, and that makes your portfolio more volatile. It's going to go up and down more. You might make a lot of money, but you could lose a lot of money. So just briefly, so emerging market stocks, those would be stocks in companies in other countries that are starting up. So it might be like a factory or something like that. You're investing in a company that's just getting started. So as you might guess, that's pretty volatile. You could make as much as 71% or as low as minus 52. So yeah, let's go through them and then we'll talk about them. This one's international developed stocks, stocks in countries that are more developed. Once again, it's on a riskier scale, but you might make more money. US small cap stocks, an average of 9.1%, but it's stocks which are more risky, so 43 to minus 36. REITs are real estate, and they usually mean, they usually mean like corporate real estate, not individual houses. So strangely enough, those are a little bit more stable than small cap stocks, which is not what I would have expected. Large cap stocks, those are the big companies, so they'll be a little bit more stable. And it's 9.5 on average from this time period. But if you notice, it doesn't have as big a range. The positive range is not as big. And it's a little bit, let's see, that's minus 33. It's a little bit lower, but what you earn is almost the same. Gold, that was another one I was surprised to see is being relatively stable. The average was like 3.2. High yield US bonds. So these would be bonds from companies, and those are around 5.5, but as you can see, they're more stable. You're not likely to go up and down as much. All US bonds, 4.7 average, and again, a smaller range. International bonds, which I'm kind of surprised to see it here, 3.6. So based on this, you wouldn't have earned as much, but the risk about the same. And cash, here's cash. So here's the cash, you guys. It's down here at 0.7. There's still a risk because interest rates change. Could go up to 5 or down to minus not 2.9. And that would probably be the effect of inflation. So when you look at this, it kind of tells you that
there's a whole bunch of different assets. And some are going to be riskier than others and some are not. And you're going to earn different amounts. So I guess this basically tells you that you can't run out and buy just one type of asset. You're going to need to spread it out, and that will spread your risk out. And it will also change how much you earn, because it'll be averages of the different asset classes. Yeah, so I don't know. Also, as a result, the ones that are riskier, you tend to have less of them in your portfolio because you want your portfolio to be overall stable and not going up and down a lot, because then you can't really depend on how much money you have. Let's go look at the next one. So this is kind of the same thing, but in a different form. It's similar to one that Sarah shows. This one is from, this is more recent, 2001 to 2019. So cash is very, very safe. You're probably not going to lose value, but we're not going to make very much. And then it just kind of goes up the chain. So here's bonds and treasuries, which are also like government bonds. So those are not as risky. And they gradually, make a little bit more, but you're not going to make the same as you would if you decide to do some risk and get some of the S&P 500 stocks or mid-cap or even REIT. There's REIT funds where they have real estate. And here's emerging markets way out here on the end, very risky, but high returns potentially. So crypto would be out here too. It would have a lot of risk, but potentially high returns. So what you want to do when you're building a portfolio is have a combination of these. And Sarah, on her, she has kind of like a circle around here where you kind of get in the sweet spot where you have bonds and stocks. And if you want to be riskier, some of the things where you might make more, but they might be a little bit riskier. Okay, let's go to the next one. Okay, so asset allocation is balancing that risk versus return. So when we start talking about balancing our portfolio, we're going to look at what your risk tolerance is. Basically, how much risk can you take? Are you somebody that if the market goes down, you freak out and you just can't stand it? So then you probably need a more conservative portfolio that maybe doesn't make as much, but it's more stable. You won't lose as much money. So asset allocation, I've seen asset allocation also referred to as portfolio balancing, but I decided that we're going to focus on assets this time, so it's asset allocation. Let's go to the next slide. So here's kind of a cool slide that I found, which kind of shows these different portfolios and how they kind of go up, the risk side and the return side. So the conservative would have fixed income, so that would be bonds and things like that. Equity, that's the stocks. So that one has a low expected risk, but not as high a return because fixed income, those bonds were around 5%, and the stocks were around maybe 9 or 10%. So when you average them out, you're going more towards 5%. And then this just moves up moderate. You have a little bit more stocks and a little bit less bonds. Balanced, it's almost half and half. And then growth, or also called aggressive, where you have a lot of stocks and not as many bonds. And
Just a question.
yeah, that's fine.
I feel like a lot of the things that I've read have to do with age and how much time you have until you retire should be how aggressive or not so aggressive and how you allocate. So I'm kind of curious how this considers age.
So so this one doesn't really consider age. It's just I liked it for a way to visualize what do their portfolios look like in general if they're conservative versus aggressive. So if you're nearing retirement, you probably have a more of a conservative portfolio because you don't want to retire and then not have any money. So for example, in 2008, the people that were mainly in the market lost half of its value, and suddenly they didn't have enough money to retire. So they had to work longer or sell stocks at a loss. So that pointed at why they would need to be more conservative. So I tend like aggressive, but it's not really the ideal thing to do if, like, well, I'm not working right now, so I probably shouldn't be too aggressive and have to get some of those bonds. So yes, the things that you would look at are what do you want to use the money for? Because you could have different portfolio plans based on what you want. You could say, well, I'm saving for a house, and this is how long I'm going to save and when I want it. Or I'm saving for retirement. It could be I'm saving for retirement, but I don't have very much time. And then you have to decide, do you want to be riskier to make up that growth? You know, maybe while you're still working, or do you want to still be conservative and maybe have to work longer? So yeah, there's lots of things like that when you consider that. But we're going to talk about that more when we're talking about balancing. So yeah, so I thought just what I envisioned, we would talk about all the different issues and things to think about, and then you individually, while we're here, would try and come up with what you think your portfolio should look like. Like, what's your risk tolerance? What are you using the money for? How long are you planning on investing in it? And then come up with like a goal for what you want your balance to be. Oh, I was also going to say, this one doesn't have cash in it. Usually you will have some cash in all of your portfolios. One thing, because it is stable, you know, it's in there, the bank, you're pretty much just depending on interest rates. But also you want it in your portfolio in case there's something you want to buy. Say the market goes down and you see some really good deals, or you had your eye on a particular fund or stock and you want to buy it. If you don't have any like cash on the side, you can't take that action.
One downside of that, if you have some cash resting in your account, though, it's going to earn any money at all. Right, like so you have to get the cash from another account, and it takes, like, they have wait times on the transfer.
Yeah, yeah,
Unfair.
that's true. Yeah. Yeah, I guess you have to decide how important is it to have the cash available. So you could do the exercise of, you know, I'm going to keep my eye on something I want to buy. Am I really going to wait for it to get low, or do you not really monitor that stuff at all? In which case you can have just a smaller amount of cash ready to invest. Because lots of times people have the cash set aside, but they don't actually monitor things and see, you know, oh, now's the time to buy. So if you're not really doing that, you don't have to keep as much cash.
It's a lot of, how much, monitoring, I mean, that's the question.
Yeah, I don't know a good answer to that, but there are tools, like if you sign up for Yahoo Finance.
Monitor what? Oh, Yahoo Finance. Oh, like, if you have stocks and, it's a good stock when you buy it and then like, 10 years later it's tanked and like, what do you do with it?
Oh, yeah.
Like, you have to monitor, like, at some point you should have sold it when it went up probably. But then again, sometimes they say, I think like Warren Buffett, he doesn't really sell stocks. I heard he makes a lot of this money from the dividend on the stocks. The stocks can go up and down, and the dividends.
Yeah, his philosophy is pretty firmly towards, do I think this is a good company, regardless of what it looks like right now. So to your question about when would you monitor, what you could do is say, I'm gonna check every quarter, or I'm gonna check every month. And then just say that's your time to go and look and compare it, once a year. Maybe that's when you rebalance your portfolio. So, yeah, there was somebody who was in our group who had she had like 10 index funds, and she didn't look at them until the end of the year. And she rebalanced them all and just kept going. And that was very successful.
There's something that I can't remember. I'll look at my phone again and see if I can find it. But every day it pops up. I can put in like Bank of America, and then I can put in whatever stocks I want to monitor.
Okay.
And then every day it'll give me an update on my phone. It'll just show up.
Oh, really?
I'm just a zillion of those, like watch list is one of them.
Oh, okay.
And if you go in and change it,
As far as like, say, like notify me when this ticker symbol goes above or below. But I would also remind you guys of what Sarah always tells us, and all of these things is trying to time the market. I don't know, first of all.
Yeah.
And if you have one, then I don't know why you're sitting in this room. So basically what that means is that before you put your watch list and things, I would ask, why do you want to know? What are you going to do with that information? And how does it play into your larger vision and your long-term plan? Because if you panic sell, right? So like in the 2008, people who walked into their stuff and said, oh, shit, I've lost all my money and it's going to hell, I should sell it all. And they did, and they're like, I'm gonna wait until to get back in. And so they cashed out at a great loss. And then years later, they bought back in at a freaking high, and they didn't get all that growth, right? So basically what it is, and this is what Warren Buffett tells you, you're not trying to time the market, because no one knows. Like you just said, you want to sell it at times. What the hell is that? I mean, you don't know, right? And so and I think the question about like how much cash and the balancing is, when do you want to use that money and how much do you want to have at that time? And you kind of guesstimate, that's all it is, about what that value would be in the future, because you can't really know.
So if it's getting close to the time you might want to use it, say, you've been saving for a house down payment, and so you were in stocks a lot, and you got to where you wanted, you should put it in something more conservative if it's right before you're going to use it. Either in like really solid bonds or CDs or something like that, because you might find the house you want, but if it's in the market, you really have no clue what the market's doing. I mean, because things are totally outside of your control, what the market does. Like the bad news changes the market, and you don't know when bad news is going to come. Yeah.
One of the things that I've done, being my age, I guess, is if you enter in it for the long haul, if you did it in reinvestment, remember when that market goes down, you're getting more shares. So that's one way of making it grow, is when it buys, you're buying in low too, unless you panic and you sell. So that.
Are you saying that if the stock is low and you're, instead of doing, you can either get your dividends in cash or get your dividends in stock?
Reinvest.
Right, so
Buying
what
more.
I've done is I've reinvested in my stocks that are so high that I can't really afford them anymore.
Just depends on if you
Per
can.
share.
Over a period, we're not talking about a year or 2 years.
This is, I
Long
think it's the same difference.
if they're pretty good stocks.
Yeah.
Go up and down.
So it's usually with the company, you set it up with the company, and you get your dividends, and they'll buy like minuscule amounts of the stock, and then just keep doing that for you. And that's how it grows. You don't have to put any more money into it.
Right, it's reinvested, yeah, it's an option in your
Yeah.
account, reinvest or.
So it shouldn't make it like, it's too expensive and you can't do it.
No, it's just that when you get a fraction of a share, it's like, well,
And that's what Charles was saying, is when that stock goes down, and you have a dividend, you can actually buy more because it's cheaper per share, so you actually get more during that.
yeah, then I'm like, do I want to buy this stock? It's low, I mean.
Oh, yeah.
Okay, so here's, like, I asked my 16-year-old, because he's like, blah, blah, mom, blah, blah, money, blah. But I'm like, dude, the stock market's down, what does that mean? He goes, stocks are on sale. And I'm like, yes, go buy some. Like, literally, you're gonna buy some, and I give him his statement, like, here's what you just bought. And so he knows. So I would say that, yeah, stocks, when it goes down, it's sucky if you want to take the money and spend it right now.
Yeah.
But if you aren't wanting to spend it, shit's on sale.
Yeah.
But you have to actually know how to, you have to know how to evaluate stock, and that's pretty cool.
And that's like a total.
Yeah.
And it's like, it's science and an art together. Yeah.
I think the thing
If
about,
somebody knew the absolute answer, that person, would want, they would be the only finance investor that people go to.
I feel like the thing about asset allocation is that it forces us to kind of be agnostic about what's going on in the markets. And it's like, you focus on like what you need and like how long is your time horizon versus like what is the market doing or like what are these individual companies doing. I even think of like, Courtney, I don't know if this is like related to your question about the ages, but there are probably target date funds that mirror these like conservative, moderate, balanced growth. So like if a target date fund is like target retirement, I don't know, 2070 or something, then it's probably going to be closer to the growth. And those target date funds, they rebalance on their own. Like they have the fund managers that rebalance on their own, and they're totally agnostic about what's going on in the market, right? Because they're like, okay, if it's 2070, and like every year we adjust it, we make it a little bit less risky. And then when you're close to retirement, when it's close to 2070, then it's like, okay, you're probably ready to start taking the money out, so it's less risky. So I think that asset allocation is less like, almost like you're putting blinders on and just like thinking about, okay, like what do I need this money to do for me? So I don't get kind of caught up in like, oh, like this stock's on sale or this stuff's really expensive.
Yeah. So, Jesse, do you know about target date funds?
Yeah.
Okay. So, we were going to talk about it because I have a 529, which is like a college fund, target date fund, because those I think are super cool, like Gwen said. So we'll talk about those, but they're really good starting places because you don't have to do as much thinking.
I have a question.
Yeah.
Just your opinion.
Yeah.
For a 401k, you do get yearly asset allocation versus, and then you get more options of like different names, like Vanguard, 2050, all that stuff. Would you, for yourself, choose something yearly based, kind of like this? Or would you choose like a Vanguard or would you like do 100% in your yearly one, or would you choose like?
I see what you mean. I've done it both ways. So I usually maxed out my 401k as much as I could put in there because that's retirement money. So you're not paying anything on what it makes, not until later. So I've done it before where I balanced it myself. But I've also done it with the target funds and I love those. Those are totally easy. And, since I know they're going to do something like this where they go from, well, they actually do the opposite, aggressive to conservative when it approaches that target date. Since I tend to be a little bit more aggressive than a lot of people, I actually pick a different target date fund from when I really want it. So instead of 2050, I pick like 2070. And so then it stays aggressive longer. But then it does all the balancing for you. So that's why I really like the target date funds, because somebody else is figuring out this part. And usually you can see when you look at the perspectives, like, okay, what has this done in the last year? What has it done in the last 5 years? What about 10 years? And that you can kind of evaluate them that way.
And how much do they charge you for those?
They're
Each one are different.
Yeah, they're all
You
different.
can look at all the fees too. Morningstar's a great website to go look at it. And you can see, what all the assets are. And basically your question was, what is your asset allocation? Which I think is where Lori's going with this, because it is like, and it's personal as far as what you want and how much to invest in each. But I have very little individual stocks. I'm an index girlfriend. So you never asked, I just looked at my fees for my target one and it's where I found that. Target is 0.98. That was my Vanguard.
That's, yeah, Vanguard is a company I really like. Yeah. Yeah, so they are often pretty low because it's not like there's like a person sweating over it because they already kind of know what it's gonna do. So they give you a little bit of help, so.
We need AI now.
Nice.
I do have a question about the stocks and these target retirements. When they break it down into domestic and they break it into foreign stock,
Uh-huh.
how would one like myself find out more about what's the
Oh.
domestic part, what's the foreign part?
Oh, okay, maybe when we get to, I actually took a snapshot of my 529,
Mhm,
which is a target date fund,
mhm.
and it's asset allocation. So usually the company will show you, but we can look at it
Okay.
in a minute when we get to mine. Okay, we're kind of on the same page?
It's all good discussion. The only thing
Yeah.
I wanted to mention when you asked about how much to put like in your retirement fund. So like now they have it set up to where you can start as low as you want to, and you can either manually increase it every year that you go along, or it'll automatically increase. Like where I used to work, they just automatically increased it. So if you can't start out with the max, that's fine, as long as you start out with something and you're paying into it, and then each year try to add, even if it's 1% that you increase it, just try to keep increasing it until you get to the max.
All right, well, I shouldn't try to do this without glasses because I'm over 40. Over 45.
Do you know how we find out what percentage we're paying our advisors? Like, is there an obvious spot that you can find that on your app? Like,
It depends on what their fee structure is. If they're, sometimes it's buried in the quarterly reports. If it's the, and so when I accidentally click that at the presentation. And then sometimes it's on their websites, whoever your advisor is, would tell you how if they're
to Google it.
AUM, assets under management versus fee only.
That's basically what it is.
They're aware that I can find somebody who is hourly. It's, asset under management is the most popular, that most advisors charge. And some of them may just have some. What's the? 0.89, that's too high. What is it? 0.89? 0.89 of what? Don't pay a minimum of 0.89 per year to visit services, I don't know. 0.89%.
That's like 1%. I mean, 1% must be pretty standard.
More than 1.5% is actually, yes.
But the more money you have, the smaller amount that, like, if you have gobs of money, 1% is not gonna be that much.
No, it'll be more.
Yeah.
It's more money,
Yeah.
but it's not as much of a concern to you.
Yeah.
if you have one.
You're basically giving that person their money though, so that's what you need to think about, is that you're giving them money and they're managing 1% regardless of what they do. Versus
Well, one
like,
thing I've heard about financial advisors is that, I mean, a lot of times with stocks, if you like buy Microsoft, you buy Apple, you leave it there. But like you're paying a financial advisor, and so they're constantly rebalancing, which is fine, but I mean, does it really need that much balancing?
No, you probably can do it yourself once a year.
Yeah.
And for somebody who's chasing cash rates, if you're okay with giving away 1% to an advisor. I just.
No, I'm not, I don't want to give anyone money. But like, you know, lately when you look, you're like, oh my God, the stock market is really down.
Okay, so, so the next aspect of asset allocation we're gonna look at is balancing different asset classes to withstand future downturns. And so what you do is you try and look for things that have low or no correlation. So if you're looking at financial papers, you might see this word correlation. So we're gonna do like a really basic example to talk about it. And so this is something that you might not care about, but I think it's good to understand. You do care about it when you're at Sandy's level, but if you're starting out, you probably don't care about it. But it's good to have the idea of it, because you can do some kind of rudimentary kind of like, am I doing this right? So go to the next page. Okay, so here we get to have, we're doing an example from the grocery store. If the price of milk goes up, when the price of bananas go up, let's see a show of hands of yes. Okay, how about a show of hands of no?
No, I don't think we're.
I don't think they're correlated. So, so I would say no. So they would say it's a low correlation or a negative correlation. What about milk? Do you think milk is correlated with cheese?
Yeah.
Yes? Okay. I think so. So there's a high or positive correlation. So let's look at stocks. So do you think Coca-Cola is correlated to Apple?
No.
No, okay. I said, maybe if the entire market's going up, it might look like it's correlated, but it's probably not correlated. What about the memory chip company Micron and Dell? Do you think they're correlated? Yes, they are correlated. And there's actually an article about it. Apparently in 2022, Dell was going down because I guess personal computers are not as desired now that we're not staying at home as much with COVID, and it brought down Micron a little bit. So one thing you might also think about is, well, these are both tech stocks, and they both deal with parts, computer parts. So if you were adding stocks to your portfolio, you might not want to have too many that are dealing with parts of computers. You might want, let's say you really love Micron and it's low, you could, but you really like tech stocks, maybe you go with something else like Apple or Google, something that is not directly tied to that market. So this is one of those things that you might not need to know unless you're getting really in depth and you're doing stocks and you're monitoring your portfolio. They have portfolio tracker tools where they will tell you, they'll calculate out the correlation. There's actually a mathematical formula, and they'll tell you if two things are correlated and how much. So if it's 0, there's no correlation, but they have a scale from 0 up to 1. That means they're correlated. The closer to 1, they're really correlated. And the closer to -1, they're not correlated. So, like I said, something you just have to be aware of. In the big picture, if you're doing a bunch of money markets or ETFs, you don't want a technology money market and a technology ETF, because you'll have your big, like we looked at the big pie chart, you'll have your big amount, and inside of that, you're kind of picking what goes in your stock section or your bond section. So that's when you might be considering, okay, is there any correlation? Just something to think about when you're doing it. But if it's something you're like, I don't even care about this, then you just blow it off. Because, yeah, I didn't really learn about it until I started really studying financial stuff. Okay. Okay, so here's another little thing, and this is mainly a discussion thing, but stocks and bonds, people say they're not correlated. And so usually that's why the portfolios have stocks and bonds. So if bonds go up, it might be stocks going down. If stocks go up, your bonds might go down. And so you balance it out that way. But apparently, historically, they weren't correlated. So this line here is their correlation line. And remember I told you that it goes -1, 0 to 1. And this line just represents how much stocks and bonds are correlated. So 1985 to 2000, it's above the 0, which meant they were correlated. So that meant they would kind of go up and down a little bit together. And then starting in 2000, it went below the 1. So they weren't correlated. And that's when they started seeing the opposite, stocks and bonds going up and down separately. And so one like logical way of thinking of it, when I think about stocks versus bonds, is when the market is really volatile or maybe going down, people are like worried. And so they'll go into bonds and buy bonds because those are more stable. You don't get as much money, but they're more stable. So you have all these people now that are suddenly over there buying bonds. I want some bonds. I want some bonds. You want some? And so since everybody wants the higher interest rate, but there's fewer of them to sell, the prices of bonds actually go down. So that's where you kind of get, I'm not explaining it well, but you kind of get this up and down with stocks and bonds. I explained it better last time. But here's something interesting that I saw in several articles. They started noticing that here, 2020, it's starting to go back up, as if they're going to start working together. One of the questions is, does that mean my portfolio is not going to be as stable as I thought it would? It might be. But overall, bonds are still more stable than stocks because bonds are loans at a known price, a known rate. And so they still can form a good backbone in your portfolio. One thing that they're wondering about is if inflation, since inflation is still going up and the interest rates are going up, if that's having an effect on this. These things are sort of like, the butterfly flaps its wings and, somewhere over in England, somebody drops their ice cream cone. It's not really that obscure, but since the system is so complex, they don't really know exactly one-to-one what causes things. And so I saw several articles where they're wondering if it's related to inflation and interest rates going up because they saw that in this time period. So if you are interested in this effect and are really concerned about it, this article here, and you guys will get the handouts, that was the article that really explained it really well and talked about are they really changing? What's going to be the impact for me? Do I need to be worried? The general consensus was, no, you don't need to be worried right now. But it just points to the fact that things are changing in the future and nobody really knows what's happening. Okay. Yeah. Okay. So there's, like I said, lots of different aspects, but the main goal is you want the highest return for the lowest risk. And like I said before, we're going to talk about portfolio balancing next time. But for now, since we had this talk about assets, now we're going to talk about you figuring out what your asset allocation is. So here's the steps I decided we're going to do. Your emergency money is not your investment money. That is money that you have set aside for an emergency. You can't think of it as your investment money. Otherwise, it might not be there when you need it. So step one is figuring out how much your emergency money is and setting it aside. Step two, determine your current asset allocation. And then next time, we're going to talk about risk tolerance, figuring out what your target portfolio application would be, and talk about like when do you rebalance, how do you rebalance, what are some methods for that. Okay, so you guys probably know how to do your emergency fund, but I went ahead and added this in here. You basically look at what you're spending every month, decide if some of these are needs versus wants. If they're needs, you know for sure you are going to have to set aside money for those. If they're wants, you maybe have to set aside money. If you're laid off, are you going to keep Netflix for 3 months? Because that's really a want. Or are you gonna cancel it right away because you're using your emergency fund? So you have to kind of like think about it that way.
Now that they're not letting people share their password.
Yeah. Letting people share the passwords.
I was gonna say, because then I'd be watching a lot of Netflix.
Yeah, you're home looking for jobs. You need Netflix. Yeah.
Like, can you actually be able to?
Yeah.
Yeah. Yeah. So, this is another one of those things where people have different ideas. The minimum I've ever heard is 3 months. I've heard, if you consider your job less stable or your industry less stable, 6 months. I've even heard a year, you set aside enough for a year. So that's one of those individual decisions where you have to decide how much it is. You have to guesstimate how much is that going to be for 3, 4, 5, 6 months, and you get that money and you set it aside. So maybe you put it in one of those high earning funds that Courtney knows about. But it's money that you don't invest. You don't consider that part of your investment. So that cash we talked about before that's in your pie chart, that's your investment cash. That is not your emergency money. Okay. So,
So Lori, if you're looking to get quick money in regards to say you have you want to buy a house or something like that, would stocks be the way to go? Because it seems like that wouldn't be the smartest thing to do, but maybe a bond or a mutual fund or something that's a high yield that you can keep for a short period of
so
time.
historically, stocks make more money than bonds. Bonds are usually around 5%. Stocks are going to be like 9 or 10. And maybe you compromise and you do a combo of them where you're not just totally into bonds where it's really safe but pretty slow. Maybe you go ahead and do half and half or 3/4 of one and 1/4 of the other.
Oh,
Yeah, I would do something like that.
I have a,
Yeah, Sandy probably has ideas.
if it's money you want within the next 5 years, even Sarah would tell you, don't invest it. It's too risky because if the market crashes, then, and you need to pull that money out, then you are forced to take loss. And so that's the downside to it. So I don't know any quick ways to make your money grow faster, because the benefit of stocks is that time in the market, because you may have a year where it's 4% return, but then there may be a year that's 12%, and on average, you get that 8 to 10% over that stretch of time. And so the other piece to that, on a 5-year horizon, you could look at doing I-bonds, inflation bonds, or things like that with Treasury Direct. But you could look at the details, what's the minimum to invest and what's the timeline. So you usually have to hold those for 5 years, I think, is I-bonds. And then if you take it out before that, you just lose 3 months worth of interest. So it could be, an option with that. And then of course, with bonds, when you get into it, especially Treasury, then you're locked into whatever that rate is. So if interest rates go up, well, now you're not earning as much as you could and you're locked into it. And so that's the downside of a bond, but you're still making more than what you would have if you just sat it in.
Yeah, and I think I've heard Sarah say that, she did say with stocks, you have to look at least 10 years, thinking that you're going to have your money in there for at least 10 years in order to get the average across those ups and downs. Okay, so how do you determine what your current allocation is? Tools at your investment company like Fidelity or Vanguard, if you click on them, it'll show you on a little pie chart or something like that. You use a spreadsheet. I found a spreadsheet that I'm going to share with you guys. There's different tools that you can use too. Usually have to pick one. And when you're looking at all of this, don't forget these other things: 401k, stocks, treasury bonds, real estate, because those are part of your pie chart, your allocation. So let's see. So here's 529, and it's a 2030 portfolio. So I just clicked around and it had this picture on there. So It's got, some stocks, a little bit more foreign stocks, lots of bonds. Short term, that's, cash, or sometimes that's short-term bonds. Other and unknown. So other could be, like they call them like alternatives, and it could be some of the riskier ones, like emerging market or something like that. I doubt that's what that is, but I didn't actually look.
Gold or some other.
It could be
Artwork.
gold.
That's it.
NFTs.
There we go.
Yeah, what would NFTs be doing in my moderate portfolio? So anyway, so this is Fidelity. I just clicked around and it was pretty easy to find the chart. On the next page, I have an example from Vanguard. I did have to click around more on this one. And this is just like a regular Vanguard IRA that I inherited from my dad, who loves stocks. Like even in retirement, he was mainly stocks. And so I'm 96% stock and only 4% short-term reserve. But this is what it looks like on Vanguard. They don't need it much. Okay, next page. Okay, so I found this spreadsheet, which was originally from this URL. I modified it to make it like a little bit more on target for what we're talking about. And I have it on a Google Drive, and it's a really long, ugly URL. So I posted the URL on Facebook in the comments for this event and on the comments for the meetup. I'll post it again on Facebook. And it's basically just an AWIG Google Drive that we have that you just copy it and then you can put in your stuff. The cool part about it is it uses Google Finance functions. I should have taken a picture of it. There's a page which is your holdings, and you go in there and you say, okay, well, I'm gonna do my 401k, and it's got this fund, ATF. You just put that in, and then you go over and put in how many shares of it you have. And the Google functions will fill in the name and the price, and then show here's how much you have. So you just go through all of your accounts and put in which account. Oh yeah, there it is. Go to the second tab, holdings. So this is just example data.
Well, I think that's the most, yeah.
Yeah, so, basically just change the values in yellow. So like, here's this person's 401k, and they have these funds in it. They just put that. They didn't have to type in this big, long name. They did have to pick the category. Stocks, bonds, alternatives, cash. They had to put in how many shares, and then it did the rest of this. It went and got the latest price and figured out how much that means, and then it calculates out how much a percentage that is. So you fill in this form first, and then you go to the first tab, and it pulls all that data and puts it here in your actual. And the idea is that you figure out what your target is, which is what we're going to do next time, and it'll show you the delta. This threshold is basically when to turn these red. So when should you be alarmed? Oh, when it's greater than 10%, when it's greater than 2.5. I left them in there, but they're kind of not needed at all. They're just kind of thin. So yes, there's this made up portfolio's got 837,000. And here's the nice picture of what it looks like in the pie chart. And then this other pie chart is what you want your portfolio to look like.
That's awesome.
It is, I totally stole it from somebody. So it says it on the, so his name is still in there, like, asset class, so click on that. And scroll down, there's where it came from. Yeah, and, go up to file. A file, you have to pick, make a copy. And then it'll make a copy and then it'll save it, like if you're logged on to your Google account, it'll save it and you can just start putting in whatever numbers you want. Yeah, it was a really cool spreadsheet, because it's a nice way to do it and see some results without having to do some of the other companies, which are like, let's see, so like some of the other companies are like, Empower and Mint. Yeah, which are good, I'm sure they're perfectly fine, but, like, go to the next page when you get a chance. But, these two, the first two, the Sandy was saying she got people calling her, and it connects to all of your accounts. I'm kind of like an internet phobe, and I don't like the fact that these companies that I don't really know have all my login information. And so that's one reason I don't use them. But I know several people that have used Mint in our group that really like it. If you wanted to like use Quicken apparently has a couple of products that you can pay for monthly. Okay, go to the next page. Okay, so yes, this is the homework. If you so choose to do your homework, determine how much your emergency fund is and figure out where you're going to stash it. Look at the current assets across all of your accounts. Maybe think about merging some, it's possible, but you have to figure out where you currently stand. And then next time we'll talk about where you might want to be and what steps do you want to take to get there. I had my stuff all over too, and I just gradually merged them all into one.
That's what I think I would do.
Yeah, it makes your life much easier. Yeah.
And then the emergency fund part, are you suggesting that that be in a separate account by itself?
Yeah.
Definitely. Yeah. Because, well, and that's what Lori had mentioned too, like you have your emergency fund and then you have cash that you set aside that is there so that you could buy funds or you can invest in whatever way you want, but it's earmarked. And you actually say, this is money that I'm choosing to have here. So when stuff's on sale or I see an opportunity, I can buy it, as opposed to emergency funding.
So would this go into like some kind of high yield savings account or does it matter?
Yeah.
I feel like my opinion would be a high yield savings account, because if it's an emergency fund and you need the money right then, and you've got the debit card to access it right away. As opposed to if you would need to make transfers from somewhere else and wait, however long for the money to settle, like it's really an emergency, then.
I even wonder, I mean, you don't have to have all the money in one place. You could say maybe you have 3 months in something that's really accessible but not earning very much interest. And maybe you have another one that's at one of those high yield accounts or a CD or something, where it's going to be available, but maybe not tomorrow, but you still have it and you can pull it really easily.
Okay.
I think one of the things I would do is how much money do you want to have in an emergency account? And actually do the math on how much you're going to earn, because your interest rate is APY, so it's an annual yield, right? And then tell yourself, oh, I can earn $60 this year in interest. Is it worth my time to shop around the high interest and move my money around, open up an account, and close accounts? Like, I'm of the philosophy, like, I'm not, like, I'm chasing bigger dollars than 60,
Right.
or even a couple of hundred, because I'm working on, like, how can I generate, when you tell me you can generate
thousands of dollars in interest, okay, now you've got my attention. So I would, yeah, put it, I think what Lori was saying too, is if you really want to take a stash, a pool of money, that's a lot, put somewhere you can access it, so if it is an emergency, you can get to it. That's the whole point. It's not meant to earn you money. And then if you really have a bigger pot, then move it somewhere that has higher interest, whether that's a money market fund or something like what Lynn was saying, that's harder to get to. If you really, some people just can't stand the fact that their money isn't earning them money. I've given that up a long time ago because I find for some people that do that, I'm like, where else are you giving up? There's probably other areas of your life where you can actually make bigger progress, but you're focusing on the small stuff. Because it's the easier stuff to calculate.
And I would even add that if it keeps you from doing it, because, oh my gosh, now I have to do all this research and find this thing, then it's not worth it to do.
Well, it's just that, like I know the money's there, and so I never set it aside in any particular, like, I was like, if I need it, it's there in the account, but I never said it specifically, like, this is my emergency fund account.
I think if that's what it's personal, so if you sound like you're disciplined enough not to go burn through it, right?
Oh,
it doesn't really matter. If that's what works for you and you already have it and you're like, okay, I know that I know that this amount in this account is really my emergency fund and I'm not gonna touch it, then I don't necessarily, I don't see a reason why you have to separate it out. It's
Yeah,
just,
I guess that was.
there's no reason.
Yeah, it wouldn't like, oh, I gotta set it aside because I'm gonna spend it.
Yeah, okay, so yeah, you don't have to do it. Yeah.
It's not set aside.
Yes, so you would maybe just do the mental exercise of figuring out like how much should it be, and realizing, okay, if I needed to, I have this.
Right. Okay.
Yeah.
So for FDIC purchases in a bank, what is I can't remember, what's the max amount that would be insured if a bank fails? Like what happened?
$250 per person. Per person per bank.
Yeah.
Is it just savings accounts, so does that apply to money market accounts?
It's
Money market is a different, money market is SPIC.
It's a different.
It's a different, insurance. Yeah,
Okay.
I think it might be the same amount. Okay. 250, right?
I don't know.
or is it per person? Or is it per account or per person?
Per person, per bank.
Right.
But if it's a joint account, then it's still per person. So if it's a married couple, then 500. Okay.
Okay. So, you guys can stay and work on your stuff or ask questions. That's what we had planned for the rest of the meeting.
Thank you. Thank you.
Yeah. Thanks for coming. Thanks for coming.
We had a question on that. Somebody was asking about, okay, Emily's asking, how do you consider real estate, like when you're thinking about asset allocation? If it's your primary residence, you omit it in your calculations?
It's not really something you're investing. So, it would be part of your net worth, but it's not, you're not gonna sell your house and then have nowhere to live.
Yeah.
Unless that's your plan. But usually I would say your house is not part of your investment.
What about a rental?
Rental, I would consider that like a real estate portion of the portfolio. Yeah.
What do you consider life insurance, a life insurance policy? Is that an asset or is that considered?
I think like if you were, for me, if I was looking at like how much money I could depend on, I might write it down there, but I wouldn't consider it as part of my investment. Yeah.
Yeah. I'm thinking about, it must be for generational wealth, because I don't know anybody who's able to use their life insurance unless you're just our life insurance policies and then borrow for yourself. You know what I mean? Like, and then, I know that maybe 2 meters to go on it. And then it's done.
Yeah, I figured out how to save it, but now I'm trying to find my drive.
Especially with the Secure Act, you gotta-
Like I was able.
So it's like, man,
I was
even
able
money
to.
to save out, becomes taxable if your child inherits it. And I was like, that. Yes.
What's the book called?
Dive at Zero. Bill Turpin, I think it's, I don't put me on the author, but it's Dive at Zero.
So you can click on those little
It was
things.
an
And
Oh,
oh, it's okay.
Yeah.
Okay.
And so there it is.
Because you recently did it, I saved it. Otherwise, you can like copy it somewhere. Okay. But yeah, you can just start editing it. But it's, I need to make sure it's in my, I need to make sure it's I have to log in.
Yeah, it's on your Google.
Okay.
Yeah.
I was like, it's saved, but I didn't know who it was. So,
It's kind of mindset. And
All
you
right.
said money is hard to get.
So
Money
yeah,
is
that
not
would
hard
be
to
just
get.
hard on.
But that is, so in that
So
year, like.
go in.
Yeah, so you would,
So see,
So
this example.
I don't,
Well, here's the.
so I understand, and you're entitled to, like,
Okay, so
I'm
you would
right.
look at one of your
Like,
funds.
it's,
So
I'm
you
one,
have what
you know what I mean? So you have to do, all
I'm
right.
gonna put in everything
Things
like
that we
that.
have
Each line would be one of
your own thing,
funds.
that I, the money is taxed for.
Okay,
And I know for me, I was the benefit of my father's, I
And
inherited
this-
some of my dad's.
this will automatically.
Yeah, you only have to do the ones in
Super
yellow.
grateful, for that, but I've also worked to earn what I currently have, like that is not by accident at all.
But I need to go, I'd have to log in to get all that.
Oh, yeah. So see, it will open up, there's some files and,
Okay, for those of y'all that are still on the call, thank you so much for joining us today. I hope that you enjoyed Lori's presentation. We've got the recording that will go out to everybody. And if y'all have any questions on, the homework that she gave us, when the next meeting that I'm calling like 102, if this was 101, then the next one is 102. If you have any questions about that, just let us know. Reach out to myself, Lori, or Sarah. But other than that, I hope y'all enjoy your long weekend. Thanks for joining.
If you just Google financial independence.
Thanks, Julie.
And I just listened to different podcasts.
Really great chat box conversations today. Thanks, y'all.
A little bit of funny, but I didn't.